Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about a new lineup of ETFs from Calamos. Now, these ETFs might convince you to take some of your cash off the couch and actually put it to work in the market. Why? Because they offer 100% downside protection. That's right, you can't get pregnant with these ETFs. You can take that rubber right out of your wallet and throw it away. It's been in there for 10 years. You weren't going to use it anyway. And you can feel confident that you have 100% downside protection. So, want to learn about them? Let's talk. If that is what you're looking for, please stick around. First of all, Calamos sounds like some sort of evil supervillain. I would probably change the name. Calamos. Secondly, with any investment, there's always going to be some sort of risk, right? It could be liquidity risk or something else that we haven't seen. This is just a quick first look on a brand new product, and it's not a recommendation for or against. I just find it a very interesting concept and something worth exploring and sharing. And then thirdly, I do own the product. I have one share. I bought it on the second day, and I bought it for about $25. So that's my investment. I could make $2 with this investment.
That's $2 cash.
Now we're going to be talking about ticker CPSM, the Calamos S&P 500 Structured Alternative Protection ETF for May. So the very first one of these started May 1st, and of course it's based upon the S&P 500 in this case. But on the first day of each month going forward, they intend to start a new one and cycle through the S&P 500. Next month will be the NASDAQ, and then the month after that will be the Russell. And this will repeat each quarter, so 4 cycles per year. Now, in order to fully participate, they recommend buying this on the day it is released. That is when the structure is initially set with the options. So the inception date for CPSM is 5/1/24, and that's the date they recommend that you buy this product if you are interested in being a part of it over the next year. Total net assets are $33 million, and they call this a structured protected ETF. And these are designed to match the positive price return of the S&P 500 up to a defined cap while protecting against 100% of the losses over a 1-year period before you consider fees and expenses. So that is important to understand. Key features here are the 100% capital protection, so no downside risk over a 1-year outcome period. Again, they're 1-year options. Defined upside participation, exposure to the S&P up to a cap, and tax alpha as well. So it seeks tax-deferred growth inside the tax-efficient ETF wrapper. So that can make a big difference. So portfolio fit could be things like a tax-advantaged cash alternative, or for retirees looking to de-risk, right, preserves capital during or near or during retirement, or for equity risk control. Again, kind of the same idea, right? Offers 100% capital protection on equity exposure for investors unwilling to risk market drawdown. So, scaredy cat, get your money off the couch, put it back to work. Maybe you feel comfortable with this idea. So, outcome performance currently shows 9% and 8.34%, and we'll go through this. That's what it shows currently if you were to buy it right now. But you wouldn't want to do that. You want to buy it on the first day of the month. Again, we'll kind of cover that. We've slide down. They've got some nice little, they can show you performance. There's only a couple days worth so far. So far, it's up though. We've had a couple good updates. But let's look at the initial value. So if you did invest on this on the first day of the month, again, if you want to wait till next month, June 1st, you'd get it on day one. Fund price will be $25, okay? And for this particular one, based on the S&P 500, we've got a starting cap rate of 9.81%. Or 9.12% when you consider fees. Okay, so that 0.69%, 69 is the fee. That's our expense ratio. So pretty expensive. And do you think they picked 69 for a reason? I mean, it is Calamos. Calamos. All right, never mind. You get the idea. So cap rates up to about 9.8 or 9%, 9.12% over the next 365 days, and you can't lose, according to them, more than 69 basis points. So that's your upside and your downside, depending on how the S&P 500 performs over that period. So with that in mind, let's take a look and see what exactly is in this portfolio based off that inception date of 5/1/24. So now to better understand this product, let's take a look at the holdings and what is actually in here to create this option structure. Now, they don't own any shares. It's just done with 3 option trades, as we will see right here, to build out this structure. They are using flex options, by the way. You can kind of mimic this on Fidelity, but they're using flex options, just so you're aware. But this first line is the act as if we own the shares line. Okay, so in this case, they're starting out by buying a very deep in the money call that acts as if we own the shares. So if we wanted to get to this base number over here, we would take the price of SPY. In this case, it was right at around 502 when they, on the inception date, they did 49 contracts. So 500 times 49 times 100 gets you to 2.45 million, very close to this base, right? So we're acting as if we own these shares, and now we're off to the races. So at that same time, we're going to go out and we're going to buy a put, right? We buy a put for protection. That adds our hedge, okay? So they buy an at the money put option that fully hedges the portfolio. This is our way of pregnancy proofing the fund. So in this case, it was at the money at 502. And today, if I'll put an example up here at Fidelity, because I did it the second day and I just grabbed a screenshot. So if you wanted to do 49 calls at a 504 strike price, it would cost us about that $115,000, right? So that's where that number comes from. I'm just trying to illustrate. So that costs us money. So we're out $115,000. So if we just hit it up with those two option trades, we really need SPY to take off to recapture that $115,000 before we really become profitable. So what do we do to get that cap on the upside and reduce this number overall? Is that we go out and we sell an out of the money call. That's what this last line is here. Okay, so it was at 502 where they bought full protection. At 552, they're going to sell an out of the money call that caps the upside. Like they keep talking about that, caps the upside, but it also helps us fund the majority of the put option costs. So we paid $115,000, but we're getting about $81,000 back to help fund this, right? We're financing this option with this option, so we're only on a little bit. So that's the way we can kind of set this all up. At least it gets us close, right? And again, here's an example from Fidelity if I didn't already put it up, just to kind of show you what that would cost like and where we'd be getting that $81,000 of credit back from.
Now, if you are new to options, you find this a little bit confusing, this chart might help. So let's suppose we buy it on day one and we hold it all the way till day 365. We have three components working here. One is that long, deep in the money call. And this is the one that's going to act as if we own the shares. So we want this to continue to go up because we own shares, right, of SPY in this case, acting as if we own shares of SPY. But we capped our upside by selling a call at 552. Okay, so when we sell this call, we're saying anything past 552, it does not matter anymore. Any gains that we're going to get from our long in the money call will be offset by our limitation of that call that's going to be more and more expensive to close out. So past 552, we get nothing, but we get the maximum benefit from this fund. We're going to make about 9.5% if this expires above 552. So that's the best potential outcome. Now, the worst potential outcome is if the S&P collapses. Since we did buy a long, deep in the money call, we are acting like we own those shares. So if the S&P collapses, so does our position with our in the money call. But we bought protection at 502. So anything below 502 and this put kicks into action. So the long in the money call will lose value, but the long purchase puts will start to offset that at 502 equally, and that's going to fully pregnancy proof our position, right? Or offer us that 100% protection. Now there is a difference between the 502 that they paid for and the 552 that they sold. There's about $30,000 or $40,000 there. I imagine that will be offset with their cash position. Maybe that's the plan. So we'll kind of watch that and see how that progresses as we move forward through the year with my one share.
So after taking a look at this product, would I buy any more? Don't forget, I do have my one share. I'm going to make my $2. But would I buy any more? And I'd have to lean towards no. I don't see the risk reward at the moment, but I will continue to watch it. But with being able to make up to 10% and only lose maybe 0.75% based upon the fee, right? If there's a negative year, I think I'd be better off sitting in cash where I'm completely liquid. I can move it around. I can sell some puts. I can add some value that way. Maybe I can get up to 7, 8, 10%. Relatively easy. At least that's been in a bull market. That's where I've been able to hit. So bull market versus, making 10%, I'd make that too. I just don't see the trade-off. I don't see a reason to jump into this product at this time. So I'd love to hear what you think about this particular one. There are some tax advantages too that you should take into consideration if you're doing all this in a taxable account, holding this for over a year. You get those long-term capital gains, so that could be a factor, something I have to consider. Yeah, just a first look at these products that I kind of find interesting. So I'd love to hear what you think. Let me know. Now, I am headed to Florida. I'm going to actually the NPE show. This is the National Plastics Expo. So I'm going to be posting some stuff on my Instagram. So come over there and subscribe. Fastest robots you've ever seen. It's going to be very exciting. So come along and watch. And if you like this type of thing, like and subscribe. Appreciate you watching. And any questions, hit me up down below. We'll talk to you real soon. Take care. Whoop.